The S&P is having a tough time recovering from its worst performance yesterday, which was the worst performance in a month. We've also got this mixed set of corporate earnings that isn't really offering a clear signal of where things are going. But there are pockets of strength and perhaps even surprising pockets of strength. Take home builder D.R. Horton, which outperformed expectations. In the word of our next guest, they blew the doors off earnings and is a shining example of the U.S. home builder stocks sitting close to all-time highs. What's interesting is this is coming at a time where we're anxious about the state of housing, not just in Canada, but also in the United States, where these home builders play. Let's bring in James Callahan, Associate Portfolio Manager at Barometer Capital. Thanks so much for being with us. I love this home builder sector right now because you look at home prices, you look at activities, you look at sentiment, everything is rolling over, and then you've got home building stocks sitting close to all-time highs. Reconcile that for us.
Of course. I don't think you'd ever expect, U.S. housing affordability to be close to multi-year lows and some of the home building stocks to be at or close to multi-year highs. We saw the first example of that with D.R. Horton earnings yesterday morning. As you said, they blew the doors off of earnings. I think they beat revenue expectations by about $1 billion on a base of 6.5. They beat earnings expectations substantially as well. But most importantly, order growth only declined 5% year over year versus expectations for a decline of 20%. So a huge beat over expectations there. And also importantly, we saw the cancellation rate, which had been an issue for them, start to come down.
So I think that's important to underline. There is deterioration in their business. A, it's not as bad as feared, but B, it seems like there's levers that they can pull to manage that. And I know that they were talking a lot about the incentives that they've been offering to get people literally in the door.
That's right. So if you're to buy a house in the U.S. right now, you're looking at a mortgage rate of about 6.5%. Some of the home builders are offering incentive programs, as you said, so you come in at about 5%. That may not continue as mortgage rates start to come down. The other thing that we're looking at is the inventory of existing homes in the U.S. is also at multi-year lows. If you're looking to sell your house and move to another one, you may wait a couple of years because you don't want to take on those mortgage rates as well.
This is kind of a teachable moment for investors. We say all the time, economy does not equal equity. And sometimes a sector economically can be doing well, but the stocks don't necessarily outperform. And this is kind of a perfect example of the reverse, where the sector might not be doing well, but the stocks can still perform.
Exactly. The market's forward-looking, and this is a perfect example of that.
I wonder if that can be broadened out to the overall market. We were talking earlier with Brian Gardner about how we're probably in an earnings recession. Whether it comes in a little better or a little worse, earnings broadly are still going to decline. That doesn't mean that a market can rally on the back of that.
That's right. And I think next week we have a lot of earnings coming up. The mega cap tech companies, they're trading well. So expectations for earnings are quite weak. We're looking at controlling costs. And hopefully they come out on the other side in much better shape. And I think investors are thinking the same thing.
To your point, we're going to hear from Meta, Google, Microsoft, Amazon, all those heavyweights next week. What do you think the play is going to be into and out of earnings for those tech names?
So I do think, given the way the stocks have traded, the bar definitely has come down versus the last few years. I think versus the last few months and maybe even versus last quarter, the bar has come up a little bit. But investors are going to be laser focused on costs. We've seen headcounts come down across the industry. And so, it is exciting as we look across the valley. We'll be able to see the true earnings power of these companies coming out on the other side for the first time, maybe in their histories, because they've been quite fat. We've seen them lean out, and it's exciting.
And to what extent are you hoping or cautious about them leaning on AI as a growth trigger? Obviously investors get really excited about it. We don't necessarily see it showing up in actual growth numbers. Maybe just the promise, it's going to be great, it's going to be great.
You'll hear it mentioned a ton of times on calls and in the earnings prints, definitely. I think, outside of Microsoft's investment in OpenAI, which is quite exciting, and they'll talk about that again as they did last quarter. We're more excited about the opportunity for AI to continue headcount decreases in the industry. You can leverage a software engineer's abilities much more through using ChatGPT and the like.
That's brutal.